So good afternoon to all of you. Welcome to the webinar on infrastructure financing in downstream oil sector. Before we start the session, let us start with our institute anthem.
सद्गमय तमसोमा ज्योतिर्गमय मृत्युर्मामृतं गमय असतो मा सद्गमय तमसो मा ज्योतिर्गमय मृत्युर्मामृतं गमय असतो मा सद्गमय तमसो मा ज्योतिर्गमय मृत्युर्मामृतं गमय.
Now I'll request Roop Biswas to play our chairman's message. He could not join due to some urgent commitments. So let us play his message to all of you. Over to you, Roop. Kindly play the message.
Here today to welcome you all, our respected dignitaries, distinguished speaker, and participants in the webinar on infrastructure financing in the downstream oil sector, jointly organized by the BFSI Board of ICMAI in association with the Baroda chapter ICMAI. This is a highly relevant subject for India, where downstream oil infrastructure continues to play a critical role in energy security, industrial growth, logistics, storage, distribution, and national mobility. Really, I congratulate our chapter to just organize this program in association with our BFSI board. Congratulations to the chairperson of our this particular chapter, and also I am really thankful to my entire BFSI team to coordinate with this matter. Today, I could not become available because today we have also have another, campus program is going on, where many of the institutions have come in the campus, where we are also exhibiting our institutes, various publications, and we are also preaching how the CMA profession is very much important for the youngsters to adapt it in their life, who are pursuing or who plan to pursue commerce, who plan to pursue, this various business, studies. So in this particular webinar, I am just putting my certain words over here to all the dignitaries over here. I beg to be excused for not being able to participate physically or in online, live. Friends, this particular companies like IOCL, BPCL, and HPCL, and also the Reliance Energy, and also Adani, they are not only the energy enterprises, they are major infrastructure builders whose investments shape pipelines, terminals, depots, retail networks, storage system, digital controls, allied logistics across the country. The downstream oil sector is capital intensive, technically complex, and highly sensitive to project delays, cost escalations, and regulatory changes. In such projects, financing is not just about raising funds. It is about structuring capital wisely, controlling overruns, monitoring executions, and protecting value throughout the project life cycle. Even a small inefficiency in planning, costing, or implementation can have a large impact on project viability. That is why infrastructure financing is in this sector demands disciplined analysis, timely oversight, and strong cost management. This is where the cost and management accountants become exceptionally important. CMS bring the ability to assess project cost structures, evaluate financial feasibility, monitor expenditure, analyze variance, identify leakages, and strengthen internal controls. In sectors like downstream oil, where multiple allied infrastructure components are involved, storage, transport, pipelines, terminals, utilities, maintenance system, and digital monitoring, CMS can add value at every stage of decision making. Their role becomes more even critical in areas such as project appraisal, cost benchmarking, cash flow relevant. And cash flow is very relevant here when the review of cash flow is required to be done in this type of, you know, in this type of financing. Contract analysis is another area. Performance monitoring and cost overrun control is also very important. Today, industry needs CMS not only in finance departments, but also in project offices, procurement, audit, treasury, MIS, risk, and operational planning. Their expertise can help organizations improve capital efficiency, reduce avoidable cost, strengthen governance, and support sustainable growth in a sector as strategic as downstream oil. That contribution is not peripheral, it is central. Ladies and gentlemen, today I just want to mention you our endeavor from BFSI board continues to update, to upgrade, and to also build capacity amongst our CMAs by providing them various knowledge packs. One of the most important knowledge packs our BFSI board has prepared for all the CMAs, the aid memoir on infrastructure financing, the third revised enlarged editions we have published. And this book has become very much, popular amongst the infrastructure companies, amongst the universities, amongst the institutes who are really teaching the commerce, who are teaching in the commerce areas. Even this book has become very much popular amongst the bankers. I request all the participants who are here to have a glimpse of the book, to read the book, so that they can really have a clear idea about the entire infrastructure financing gamut. Keeping in mind that our CMS are very much important, they can play very important role, as I have mentioned earlier in my, I have mentioned you. We have launched a project financing course. This project financing course, it's a very tailor-made course. And I'm sure if you just register yourself in this course, you will be able to understand how, as a cost and management, you can navigate the entire project financing and how you can help the infrastructure financing companies. And you can also help the entire country's, infrastructure building up mission. So I am confident that today's discussion will generate fresh insight into how infrastructure finance can be strengthened in the downstream oil sector and how CMS can contribute more meaningfully to the India's energy and infrastructure story. I welcome our very, very honorable speaker, Mr. Yazdin, who has really given his time, and he has been, agreed. He has been agreed to just speak before you. And that's why I feel that BFSI board and our Baroda chapter will be definitely looking for such type of program in future also. Thank you. Jai Hind.
Thank you, Chairman, sir, for your welcome speech. Since this event is organized jointly with Baroda chapter, I now have the privilege to welcome CMA Amrita Vyas, Chairperson of Baroda chapter. Welcome, madam. You can unmute yourself and give your speech, madam. Hello. I think some connectivity problem is there. I think Madam will be joining soon. Before that, let us welcome our speaker for today. Uh, Sir has joined right now. It is a proud privilege to introduce our distinguished speaker for today's webinar, CMA Kazi Riazuddin. Sir is a fellow member of our institute, a member of Chartered Institute of Arbitrators, United Kingdom, a registered valuer under the Insolvency and Bankruptcy Board of India, and an independent director. With more than 4 decades of professional experience, he has built an exceptional career spanning the petroleum industry, corporate finance, corporate governance, valuation, and commercial arbitration. During his long association with BPCL, he was closely involved in financial management, capital investment decisions, and the evaluation of large refinery projects, gaining invaluable practical insights into the planning and execution of complex industrial ventures. Following his retirement, Sir has established himself as an independent arbitrator and registered valuer of securities and financial assets. He is empaneled as an arbitrator with several leading national and international arbitration institutions. His unique ability to integrate engineering, finance, valuation, contracts, and dispute resolution has made him a respected faculty member and speaker at professional forums. Today's topic, infrastructure financing in the downstream oil sector, is particularly well suited to his multidisciplinary expertise, drawing upon decades of industry experience and his current work in valuation and arbitration. He will provide us with a rare perspective on how major infrastructure projects are conceived, evaluated, financed, and brought to fruition. Ladies and gentlemen, please join me in extending a warm welcome to our distinguished speaker, CMA Kazi Riazuddin. Over to you, sir.
Sir is facing some internet issues. He'll be joining soon. Sir. Sir has joined, sir. Sir, over to you, sir.
Welcome, sir. I
Yeah,
think
can
some
you?
connect. Yeah, we can
Yeah.
hear you, sir. You can start, sir,
You
your
can see the
presentation.
photograph. A minute, I want to share.
Yeah,
Yes,
yeah. Please share your presentation.
Can you see on the screen infrastructure financing in the downstream?
Yes, sir.
You can see.
Yes, sir. Yes, sir.
Just hold on. Okay. So, Devendra, is it fine? Now I'm on the screen. I'm able to share. The first slide
Yes, sir.
is there.
Yes, sir. You can
So
start.
I'm-
We have.
Okay. Good evening, everyone. Ladies and gentlemen, it is a great pleasure for me to be present and speak on this occasion I think this is my first time this webinar through BFSI board to the members of the Institute of Cost Accountants of India. It has been a great privilege to be associated with the institute, and today I'm in a position to contribute something out of my experience or knowledge of working in oil sector. My sincere thanks to the entire team of BFSI, especially Mr. Chitranjan Chattopadhyay and the chairperson of Baroda chapter, Madam Amruta Vyas, to the president of the institute, Mr. Srinivasa Prasad, Mr. Neeraj Joshi, and Dipandu Roy, for taking this initiative, a key initiative to hold this webinar. If you just see the union budget for the year, for the last 2-3 years, or even right up to the last 5 years, especially I remember the union budget for the year 2019-20. I think it was presented in the month of July, exactly don't remember, I think 19th July also 2019. At that time, the Union Finance Minister, she said that we are going to spend about 100 lakh crores on infrastructure. I was wondering whether it is the union budget for the year 2019-20 or it is a policy statement for the next 5 years. It is a vision statement for the next 5 years. And true to that statement, in subsequent each year, the budget which used to be hardly 3 lakh crores, it started going up every year. Now 11 crores, 11 lakh crores, and now 12 lakh crores. Out of the total 52 lakh crores government expenditure on different sectors, as much as 12%, as much as 12 lakh crores, that amounts to almost 24% of the total investment of the government, is dedicated solely to the development of infrastructure. So the importance of infrastructure, you just can imagine. Earlier, we used to pay a lot of attention to agriculture or defense or to other sectors like education, health, and all that. But primarily, the entire focus now has shifted to infrastructure. And as a result of infrastructure development throughout India, whether you go from north to south and west to east or east to west or throughout the country, wherever you are going, there is industrial or infrastructure revolution taking place, whether under the waterways, whether under the seaways, or whether it is coastal area, whether it is roadways, whether it is airports, whether airways. Everywhere you find huge amount of development in infrastructure. One of the key element of infrastructure is refinery. Refinery development, why this has taken such a big importance. Today, as we go through, we are already at 4:15, 4:19 now. We will try to cover up certain key elements in this discussion. What is the oil value chain? What exactly it means upstream, midstream, downstream, and how value is created at each level. We will look into how India's refining revolution is taking place. In the big horizon of infrastructure revolution which is taking place, there is subset which is called India's refining revolution, and how it has become such a great strength for India to have such huge refinery investment. We will see as to how the birth of a refinery takes place, and also what exactly approvals and bankabilities are there, and then we also will see anatomy of the feasibility report. As today, for example, you have come to office, or you may be somewhere in your factory going for audit or for some assignment. As you have stepped out of your office, I mean, as you have stepped in the morning out of your house, you would have used cooking gas definitely for having your breakfast, and then you would have driven by car or by motorcycle or train or whatever, wherever, whichever transport means you have taken, definitely you have used petrol and diesel. And if you have gone from one city to another by air, aviation, turbine fuel, ATF, you must have used. And the road that is paved for you is made up of bitumen or asphalt that is also contributing from refinery production. And then lubricants, whether it is in your cycle or motorcycle or in the car or any other machinery, lubricants are there. And in the petrochemicals, in the plastics and products which you are using daily, and then medical equipment, so many other things. Everywhere the feedstock of petroleum products are used. Now, we have seen that in each age, whether it is Stone Age or Bronze Age or Iron Age, the usage of those particular items were predominant. But in the Stone Age, there was a stone. In the Bronze Age, bronze was there. In the Iron Age, iron. And industrial era, which was there about 100, 200 years back, it was completely powered by oil, that is industrial. Now, this era is full of oil, and from oil, we are migrating into gas and also further biofuels. So, this way, a lot of changes are taking place in our society. So, wherever civilization develops, the more growth takes place. Growth definitely requires fuel. Without fuel, you cannot grow. Whichever industrial economy is there, higher the amount of development, higher is the usage of oil. So that is for sure. Fuel has to be there, then only growth is possible. Now, having seen this, I just want to say that in the setting up of refinery, there are roles for each and every one, whether the person is engineer, an accountant, or a banker, or environment specialist, or lawyer, or arbitrator, or in reality, whether the person is having specialization in economics or in law or governance or company secretary. Everyone has to participate and see to it that refinery comes up. So financing of a refinery is not an ordinary project. So it is for the simple reason, it is complex, very, very complex engineering is there, and it has to be financed by different means. So this is how energy is the foundation of every sector which we have seen. It applies to all the economies of the world, and and India is no exception. Having seen this, every refinery is an instrument of energy security. Now, we have seen, for example, Strait of Hormuz was closed for some time. How difficult it was. Wherever we go, such huge queues were there, and cylinders were difficult to get. Everywhere in the restaurants, food items were cut down, and in the house, in our daily life, we were switching over from LPG to other sources of energy like electricity or something, or even segri, purane, all the old times segri or some old times coal stoves also were coming up. So this is how things were happening, what we have seen. Now, India possesses, what should I say, fair degree of crude reserves, but it doesn't have sufficient quantity. So that is the problem. So what we have to do, we have to bring crude oil from different countries and then make the petroleum products in such a way that each and every customer, each and every transporter, each and every household gets its fuel. Okay, so this is how our journey is taking place. Dipendo, can you just confirm whether the screen is okay, my movement is okay, speed is okay, or is it fast, or should I come down?
Yes, sir, it is okay, sir. You carry
It
on.
is okay, and screen is visible, movement is okay.
Yes, everything fine, sir. See, you give in the PPT format, sir, that display. your display is not in this PPT format.
Okay, in PPT form. Okay, I'll give you. ठीक है. Okay, I'll give you, just hold on. Can you see it now? It is in
Yes, sir.
display form.
Yes, sir. Yes.
The journey of a drop of crude oil. Is it okay? You can see it?
Yes, yes, I can see it.
Achha,
Everyone can
okay,
see it.
thank you. So let me start with the entire source of oil is crude oil. Whether you use petrol, diesel, kerosene, naphtha, bitumen, or lubricants, for everything, crude oil. And crude oil, as you know, it is in short supply. We are gifted with natural resources. India is a land of abundant of natural resources. But the only thing is, among all the natural resources that we are used to or which we have got in plenty, somehow crude oil is in short supply. We have got minerals of other kinds, but crude oil is something which is in short supply. Throughout India, if you just go, we don't have that much resource. So crude oil journey starts from three streams. One is upstream, second is midstream, third one is downstream. What upstream means, the entire crude oil is somewhere buried below, miles and miles down below on the earth or below the sea level, maybe about 30,000 feet or 40,000 feet or 50,000 feet. Somewhere below, there are huge deposits below the sedimentary rocks, below different basalt rocks, different types of rocks, somewhere deep below the deposits are there. So to discover that, you need to have seismic surveys, some exploratory wells, somewhere testing of those geological data, huge amount of uncertainty. What type of crude oil is there? Nobody knows whether it is thick, whether it is liquid, whether it is in gaseous form, or whether what type of hydrocarbons are available beneath the earth level. So that one has to be, and whether it is of good quality, whether it requires high processing. Let me tell you, the crude which is available in Bombay High, Bombay is one of the biggest source of crude for India, apart from something from Assam, something from Rajasthan, or something from Godavari basin, Krishna Godavari. But primarily in Middle East, there are huge deposits, and in Africa, West Africa, in America, in Brazil, and Venezuela, everywhere there are deposits of crude oil. I just want to check up whether from the people, so that there is interactive. I don't want it monologue. So can anyone say which country is having the highest amount of crude oil reserves? Can anyone on the chat line, can you just say? Just 30 seconds. Just people through the chat line can make use of it. I'm happy today we have got 208 members. Chat line is open, Dipindu.
Yes, the chat box is always open.
So the question is, which country is having the maximum deposits, crude oil deposits or crude oil reserves? No? I'm not getting any answer. Maybe, Divendu, can you see any answers?
No, sir. Still of now, nobody answered.
Okay, no issue. will proceed as they think over it, let them answer. Now the thing is in upstream, so a lot of exploration has to be done, exploration and production, commercial production. Even if you have discovered huge oil wells beneath, it has to be commercially extracted, and extraction takes its own lot of machinery, lot of equipment, lot of huge investments are required. And this game of upstream is full of uncertainties, huge risks are there unless the external prices of crude oil are so attractive, then only those people will invest, the investors will invest. Say, for example, the crude oil prices have come down to 50 or 60. Nobody will be interested in investing huge money in upstream, in exploration and production activities. So that upstream activity will become attractive only when the prices are attractive, say about above $70 per barrel or $80. It makes sense for them to invest huge funds into upstream exploration and production activities. From upstream, we will go to midstream. What exactly midstream means? The oil which is there in the oil wells, from there it has to be transported by pipelines, by railroads, by ships, by huge tankers, and it has to be stored. So by itself, it is a separate field of investment. Right? It consists of pipelines, tankers, rail, marine, terminals, storage tanks, all this, and it will become a logistical backbone for the entire value chain of the petroleum products. Then the third one, we will see downstream, where the crude oil has been extracted, it has been transported, now it has to be refined. Crude oil by itself, it is of no value to any customer. If you put crude oil into car will shut. If you put crude oil into any other machinery, the machinery will not work. So what it has to be done, that crude oil has to be processed. And for that processing, having extracted it and having transported it to the refineries, and the only it will happen in refineries. What refinery does? Refinery is a column for refining this, that is for distillation. Like, you take one material, one liquid, and you heat it from in the heat. For example, you have seen and water you heat, you get carbon, or you get hydrogen and water and oxygen. Similarly, in the distillation, when you do in refinery, as it is heated to the higher extent, it is a big column. Refinery has got a huge column, so different products come at different temperatures. The first one is comes out as the gaseous forms like LPG, LNG, those gaseous forms. Then secondly, it comes naphtha, gasoline, and then heavier products start coming in, then diesel, and then bitumen, then furnace oil. Then there are so many other materials, and then finally some sedimentary things come out that can be further processed. So from the primary distillation, lot of items come, but those items may be very, very restricted. But when such a huge amount of deposits which cannot be processed in the primary column, it will go into the secondary. If that refinery is having further processing capacity, then that residue can be further processed, and then further value-added products can be made, and further improvement of the production. And each barrel of crude oil, you will realize a huge amount of high-value products only when you have got secondary processing facility. And also associated to it are the petrochemicals. Certain chemicals which are there, those can be further used and petrochemicals can be made. So refineries nowadays are complex refineries. They are not simple. For example, in India, we had, or still we have one refinery in Digboi in Assam, which was constructed in I think 1901, and it was a simple refinery, just a distillation column. But now we have got the biggest complex refinery on the west coast of India, in Jamnagar, that is very complex, having the complexity of Nelson index number of 22, which is something amazing. It is the world's richest, or rather largest refinery. At the same time, the most complex refinery enjoying a high Nelson index number. We will come to that number little later. So downstream, actually, upstream creates value, or rather it discovers value from the crude oil, and midstream transports value. And the third one, downstream, it is the stream which creates value. So this is how I think you have seen. And then as we go to the next slide, so we have seen that upstream is the business of uncertainty because it involves huge risk, whether it is price volatility or the geological risk, which we have seen just now. Midstream also we have seen. But what exactly is the most important thing? Value is created in the downstream. And downstream, refineries are forming part of downstream infrastructure. So it converts crude into petrol, diesel, ATF, LPG, naphtha, bitumen, lubricants, so many other products and petrochemicals. These products support transportation, air transportation, road transportation, marine transportation, complete agriculture, entire defense has to be given. This oil machinery of the defense has to be moved by the petroleum sector, healthcare, and daily life. So even at home also we have to use hydrocarbon. So hundreds of end products which are sophisticated byproducts of these petroleum products are of day-to-day use. So this is having seen the utility and creation of value from the downstream. Naturally, one tends to feel that let me contribute to the growth of this sector. And here there is a chance for the banks to step in, and the banker may appear to finance only a refinery, but in reality, the banker finances the successful functioning of an entire value chain of
Correct.
Still, sir, we cannot hear you, sir. Hello.
Correct. Actually, sir, in Bombay, there is a load shedding here. He just called. He is just joining if within a few seconds.
Yes, sir. Technical problem, sir. Power off. Sir, we can see you, sir.
We can see you, sir.
Sir, please share your PPT. Yes, it has come, sir. It has come. So your audio is, you are on mute, I think.
now. Can you hear me?
Yes, yes. Now it is audible, sir.
Can you hear? Huh? It's
Yes,
clear?
yes.
Okay.
Yeah,
There is
yeah.
heavy rain here in Mumbai. Heavy rain and electricity is playing hide and seek. Just hold on. Inconvenience. Sorry for the inconvenience. In the beginning also there was a slight disruption. And thanks a lot to all the audience, all the people. People are there, I think, or they're disconnected.
No, no. More than 200 people have joined, sir. They are listening to you, sir. 217.
Are they? Okay, okay.
Yeah, yeah.
So I'm continuing. Just hold on.
God.
Sir, we cannot hear you, sir. Sir, are you there, sir? Welcome, madam. Amrita, madam.
Yes, yes. Thank you,
Uh,
Divyaji.
yes. Yes. Actually, madam, our Mumbai is having heavy rain, so our faculty is facing some technical issue. He will be. I told him within a minute he will be joining. Some power cuts have happened. So
Okay, sir, no problem.
yes, ma'am. So we regret some inconvenience. So due to heavy rains at Mumbai, the speaker is not having some issues, but he will be joining. I request your patience for the session. Thank you all.
Can you hear me? Okay. Me and my presentation.
হ্যাঁ শুনতে পাচ্ছি।
Thanks a lot. So thank you very much, friends. Thank you. So thank you very much for your great patience. In spite of because of frequent current breakdown, power breakdown here in Navi Mumbai because of heavy rains. Now, having seen this crude oil refinery upstream, midstream, downstream, we will further progress. It is an interesting topic. I'll have to speak for maybe 1 hour, 2 hours continuously on this subject. However, this interruption, in spite of that, see, where we were. Go ahead with further this one. Downstream, I told you, it is the most important thing here we felt. So that contributes to the value of the entire value chain of oil. So downstream, what all it contains, it is not just refinery. Apart from refinery, it goes to the petrol pump retail network throughout the length and breadth of marketing of kerosene or petrol or diesel. That one, thousands of outlets are there throughout India. Then whether aviation stations at each airport, which is there right from Ladakh to Jammu and Kashmir, or to even to southernmost part of India, everywhere we are now through Udan project. The airports are there, and wherever major airports are there, aviation fueling stations are there, and to the households, to the freight and logistic, whether it is through the trucks, all these things very well. Depots, terminals, LPG plants, and then naphtha, huge petrochemical projects. All those things comprise of this one downstream. And having seen this, now the lender cannot examine the refinery alone in isolation. He has to see the entire value chain. So financing of oil downstream or downstream of oil sector has to be seen in its entirety, right from upstream to the midstream to the refinery and beyond refinery, wherever the product is going, how it is going. So entire mechanism has to be understood before taking a decision for financing such a major project. So financing goes to the downstream project, but the analysis spans the entire value chain. That's what I have told. So contractual integration holds the chain together. What exactly modern project finance emphasizes contractual integration. If one link in this, the whole thing, one link, it becomes weak or is not functioning, then the entire performance just come to a halt or it slows down. In the beginning, you have, for example, before setting up an from where you will get the crude oil, what are the crude oil supply agreements. So transport will take place by tanker, you will plane, or you will by pipeline, or by other modes, how you will get into your tank, and what are the utility contracts, from where you will get power, from where you will get water, from where you will get steam. So those are the things which have to be taken decision. And what are the product offtake facilities are there, how you have to integrate all these things, and how, what type of finance, what type of documents, what type of contractual obligations are required. So entire thing has to be well thought of. So when you create a body, when you create a baby, now the baby has to have the full apparatus, full body mechanism like heart, lungs, brain, kidneys. In the same way, all these organs of the refinery have to be fully integrated, and then only it will be a functioning apparatus. So resource ownership and value creation. Now the thing is, this is very important thing. India produces only fraction which we have seen, we don't have resources. But what we have got value creator. We are the value creators. Why? For the simple reason, let me tell you, India is land of deficit in crude oil. But India is a land of surplus in petroleum products. Doesn't it sound a paradox? India is hugely importer of crude oil. India is hugely exporter of petroleum products. Does it mean something is you are able to get connect? Why it is on the one side you are huge importer, on the another side you are a major exporter. What is taking place? Because of huge investment in refineries. Now in India, we have got about 25 or 26 operating refineries in public sector, in joint sector, and in private sector. So whether your private sector is there, whether it is in joint sector or joint venture or public sector. Just Mr. in the beginning, Mr. Chitranjan Chattopadhyay made a mention as to how IOC, DPC, and HPC, they are in public sector, and other Reliance or other Nayara, they are in private sector. Each one is contributing in a major way for this infrastructure development in India. So the 25 operating refineries contribute to 250 million metric tons of crude oil processing every year. So this is such a huge capacity, and by the year 2030, we aim to have refining capacity of 310 million metric tons per annum. So you have seen this public sector and private sector. What exactly Nelson Complexity Index means? It means higher the complexity, higher is the capacity of the refinery to process heavy crude. What crude? Crude from each side, from each country, from each geography is different. The one which is coming from Bombay High is light crude. The one which is coming from Assam is a heavy crude. Another one, each one is differing in properties. Some are rich in gasoline, some are rich in furnace oil, some are rich in gas. So how exactly? For example, even in Middle East also, Dubai crude is very heavy, and in Saudi Arabia also, certain crudes are light, certain are middle, and certain are very heavy. And in Africa, West Africa, you have got lighter crudes. So, in America, Louisiana has the best crude, very, what should I say, low density crude. So, like that, different Urals, you go to Russia, you have got heavy crude. So, different properties are there, different cities are there, different product pattern comes out from this. So when a simple refinery separates crude into basic fractions, whereas the higher the complexity is, if you want heavy crudes to process in a refinery, you should have that machinery, that further distillation to get the best cracks, get the best value-added products. So you need to have basic distillation column, you need to have hydrocrackers, you need to have cokers, reformers, and then petrochemicals. So that type of refinery which is having all these things will have higher degree of Nelson Complexity Index. So this is in short, I just wanted to say this. So higher the amount, higher the complexity, it creates high degree of resilience to the company, to the processing refinery. Higher the amount of complexity it can do, even if, for example, for a few days the product is not coming from straight farmers, no problem. We will take from West Africa, we will take from Russia and process this. So you have got high degree of flexibility when your refinery is having higher degree of complex processing capacity with higher Nelson index. So higher margins are available to the refineries which are having higher complexity and imported crude and export value. Now the thing is, why refinery? India is having such huge amount of refinery. We have established right from 1901, and we are continuing to establish more and refinery. Let me tell you, the producing countries like Saudi, like Iran, like Dubai, they don't have that type of refineries what we have. They don't have such huge. The world's biggest refinery is India, second biggest also in India, third biggest also in India. So like that, India has got what advantage other countries, even of the Middle East, although they are the huge producers of crude oil, but they are not huge processors of crude oil. So that is the difference. So why? For the simple reason, the export has what value creation. Export of processed export of processed petroleum products is higher amount of revenue. See, for example, if you process 1 barrel of crude oil, you pay say $100, whereas if you process or you get out of it to say kerosene, then barrel there you will fetch $125. So that means your margin is 25. In gasoline, it may be 26 or 28, or certain times it may fall down to 17. So the price is very, very fluctuating in the entire globe. Whether it is in Singapore market or London market or Dubai market or in New York market, the products, the prices of petroleum products, the prices of crude oil, highly sensitive to headline news. Any news coming in any part of the world can impact the prices of these products. So therefore, taking huge investment risk, one has to take what type of one has to take huge analysis of past data and then bring out to some common average and then take a decision as to how to and what exactly is the sensitivity of your assumptions. There lies the decision for investment. We will go ahead further for financing. So this is how export value is created through processing of refined products. So refining capacity cannot be built overnight. So it requires minimum 5-6 years. Heavy amount of engineering is involved. Multiple components are there, hundreds and thousands of components. Each and every type of engineering, detailed engineering has to be planned for setting up of a refinery. So, and luckily, the best advantage in India is that we have got the best of engineers, we have got the best of designers and the best of competent personnel who can run these refineries. So therefore, expansion and going to the dream of 310 million metric tons per annum processing by 2030 probably is not going to be far dream. It is going to be easily, it can be done. Any questions so far?
No, sir.
Anyone?
No, sir.
No? Am I going too fast?
No, you carry on, sir. It's okay, sir.
Sure, and my visibility is okay. I mean, what should I say? At least I think you will be able to see my.
Yeah, your
probably you will not be
PPT,
able to see.
PPT is visible, sir. PPT.
Yeah, I'm in dark for the simple reason there is no electricity in my room. No problem. I'll continue. Now is the question as to how a refinery is actually born. So how the birth takes place. Any vision, for example, tomorrow you want to set up your own business, you will have vision. You will do, I want to do this business, I want to acquire this land, whether 1 acre, half an acre. Similarly, somebody who is a visionary will think over it and then he will share his vision with other people, and other people will come together, and one by one, as the vision or the idea takes concrete shape, then you start talking to so many stakeholders. It could be investors, other partners, the government of India or government of Andhra or government of Karnataka or government of Maharashtra or local bodies or talk to other oil companies, because you want to set up a greenfield refinery. What is the difference between greenfield and brownfield? Brownfield is you are acquiring the existing one. Greenfield is the one where you are putting up your own new refinery. Now let us take one example of setting up a 9 million metric ton refinery in Andhra Pradesh. To the extent that is on the east coast, to the involving 75,000 crores of rupees. So per metric ton, per million metric ton, almost it will be about cost will be 8,000 to 9,000 crores of rupees. So we will plan in such a way that we have got a vision to create a refinery or to set up a refinery of 9 million metric tons with Nelson complex index for the world to which we want to set up in the next year. So that refinery can last for 40 to for 50 years. It will continue to be yielding its products. So every great project begins before the first system. You have to have the concept. It starts with idea, demand, signal, and then pull all those things what we have seen. So where shall we build? Now, having decided we want to build a refinery, where to build, that is the most important. And another question is, before we deciding where to build, should we build? So should we build at all, or whether it is okay that we have already got 25 refineries? What is the need? Just because government has told us to have 310 million, should we develop it? So it requires the question where exactly, whether we should build at all, what exactly is the need, how much it would cost, and how much benefit we are going to reap. So unless this exercise cost benefit analysis or payback period is not calculated till that time, you cannot just like that jump into dark waters or somewhere in the deep waters and create problem for yourself or for others. So that is the thing. So we have seen all these things. Export trends are there. Huge market is available. Now you have to carry out the, what should I say, study. Only if the business opportunity itself is attractive, then only the project can move into site selection, engineering, and finance. So from their conceptualization stage, then you have to engage the services of consultants, and then the promoters will have to undertake the opportunity assessment, whether we should invest here 10,000 crores or 75,000 crores here or somewhere else, where exactly you will get higher returns. So this exercise has to be done. So for that, first thing is refinery cannot be relocated at any time. It is not a simple thing. So therefore, site selection is very, very important. Every subsequent decision, whether it is relating to configuration, logistics, marketing, financing, or flows, it all flows from where you want to put up the refinery, whether on the east coast or whether on the west coast or how far from the sea coast. All those things have to be, and how those things will come up. This entire decision. So a multidisciplinary exercise involving the geologists, economists, logistic experts, environment specialists, and planners, government officials. So everyone has to participate in this exercise to bring out and find out the viability or economic benefit of that project. So technical attractiveness alone is not enough. Environmental studies, social studies, and even what should I say, what the local people are talking, that the location, that also is very, very important. Now, having seen that, we want to set up a refinery on the Andhra side in the Andhra Pradesh. So we have to get the access of Bay of Bengal, what type of shipping lines are coming in, how far it is close to Singapore, which is the hub of petroleum products exports, and how best we are connected to Korea or South Korea, or what exactly is the level of competition from China, and also how deep water ports are available, because Bay of Bengal offers high degree of vessels which can come in. For example, in Mumbai, huge draft vessels having 40 feet, 50 feet cannot come here, whereas there it is is possible on the East Coast. Then growing markets, and then industrial system, what type of benefit, what type of land, what is the quality of land, what exactly is the geology of that area, how much water is available, whether dependable water supply and power supply is available, what type of connectivity, rail, road, pipeline, and corridors, whether it is freight corridors, how exactly it is integrated with the rest of the country. So those things have to be done. Natural hazards study has to be done. How many cyclones are coming? How many earthquakes are coming in that area? What type of flood history is there? So this is huge investment. Before investing something, a huge amount of study has to be carried on, and all these parameters which are affecting the setting up of refinery, and what type of environmental study, what type of cultural sensitivity of the people, how much settlements are there, how many villages will be affected, how people will be rewarded. So this entire location study has to be identified well in advance. And at that time, when the first step has to be taken, you have to appoint a project management consultant, and that project management consultant will take up the entire responsibility of drafting the feasibility report, and then he will work out the whole mechanics. Then you have to have project licensor from where you will get the technology. As you have said that you want to set up a refinery of complex density index of 15 or 20, then naturally that advantage is not readily available in India. Naturally, you have to get it from foreign sources. Who is the process licensor? Those process licenses in the world famous are Chevron, then Exxon or Shell or Honeywell. These are the people, and then they offer the complete package, design package, operating parameters, manuals, plus even the operating the computer software for running the entire refinery. So that type of detailed engineering, everything will be available through this process licenses. So these are the things which require detailed feasibility report, which we have seen through PMC. And in the PMC, that person, the first thing will be executive summary, then what exactly is the rationale and objectives for setting up the refinery, complete market analysis. There will be chapters on the demand, margins, how much each product has got different margins, what exactly is the product mix which are likely to come from this refinery. Each refinery, I told you, will have different product mix. Some will be very, very rich in metal distillates, some will be in heavy distillates, some will be rich very much in light distillates. So from what type of this refinery complex, it will get what exactly is the competition. Technical evaluation will have to be done, and technical evaluation, what type of technology, what type of crude flexibility, marine facility, tankage facility, site studies, this entire thing has to be done in the feasibility. And feasibility report also will consist of environmental stewardship and, what should I say, bankability. A lot of approvals are there. Let me take a break here. So just can you tell me which factor is the most critical in determining whether such a big refinery is bankable? Anyone in the questions and answers, can it be coming into this one? Just 30 seconds. A, B, C. So, which factor is most critical in determining whether 75,000 crores refinery is bankable? First one is whether a beautiful engineering drawing should be there, reputation of the promoter alone is enough, or reliable future cash flow should be there, supported by sound contracts and risk allocation, or lowest EPC contract price should be there. Then which will become bankable? Anyone? Any questions coming? Can you see, Dipendo?
Yes, sir.
I'm not able to see the screen. Answers are coming?
Just a minute, sir.
Any answers?
No, sir, as of now.
No, no problem. I hope people are there.
Yeah, more than 200 people are there, sir.
Acha, okay. So then I hope they are listening. Can they put on their cameras?
No, 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 sir, they cannot, sir.
Okay, okay. Now the approvals are mechanism of balance. So you have to open, what should I say? Environmental and social legitimacy should be there, and it should be precondition of project development. So what should I say? Refinery handles large volumes of flammable hydrocarbons at high temperature. It should not result into contamination of water, energy, or even if something happens, then how best it can be reduced, minimized, and contained, and those emissions or effluents, what type of mechanism is there, and vigorous before construction itself, what type of parameters, what type of technology is available, that has to be taken into account. So this is how it can be done. And then approval balance. So those people who are about to give the approval, they will consider maintaining the interest of the society as well as interest of the future generation of the local population. Environment impact assessment has to be carried out, and that by itself it has to be having a document inside the feasibility report. So it compels the promoters to understand that they have to respect the environment, and it evaluates the impact on air quality, water resources, marine ecology, and then on the fisheries, on the biodiversity, noise pollution, soil, and neighboring communities. So the entire economics on the environment has to be studied, then only decision has to be taken. Let me tell you, in certain projects have not taken place because of the tough, what should I say, opposition from the local population. So the baseline studies, as we have seen, all these are the studies have to be taken here in air, in meteorology, in soil condition, marine, biodiversity, socio-economic condition. These things have to be done. Then public consultations has to be held, and a facilitative process has to be done with the local population beforehand, so that the objections are not raised, and build the confidence of the local community, give them some assurance how they will be benefited, future employment opportunities will be created. And so the stagnant approvals have to come from different sources. After completing all this process of environment, hazard studies, risk assessment, disaster plans, emergency plan, fire protection plan. So this all these things. So environmental compliance is very important. Okay, 1 second.
Sir, your PPT is not visible, sir. Kindly share it.
1 second. हाँ करते इसीलिए मैं बोल रहा तो कर दो ना मुझे उन्होंने बोला नहीं मैं बोला तो मैं करके बोल देंगे मैं वो कुछ नहीं तो देखो जल्दी बात कर दो इसको उसी को करना कर दो आगे sorry can you see my screen now?
No, sir.
Hello.
No, sir.
No, screen is not visible.
No, sir. I think you can log off and log in, sir, because I think some internet issue is there from your end.
I think it is a very bad. I think heavy rain, a disruption from rains. 1 second. I think it is. Can you see the screen now?
Yes, yes, now visible, sir. Now visible.
Time is not merely a scheduling parameter, it is financial variable. Can you see?
Yes, yes, it is visible now.
So nice, so nice. Thank you, gentlemen, ladies and gentlemen. Sorry for all the interruption today. There is no electricity, but still somehow through mobile data on. I'm connected. Thank you for your patience. I would love to have certain questions. I love to have certain chat. Want to see your reaction. Whether it is, if you are able to, it is reaching your ears or it is reaching your, you are able to see my screen. Can anyone confirm or can anyone speak?
Sir, they cannot speak, sir. They can only write in the chat box.
I cannot, they are muted completely.
Yes, yes.
Anyone write in the chat box at least? I can't
Yeah,
see
yeah.
anything.
There is a message. We can hear and see your PPT. This is the message we got right now.
So nice. Thank you. So nice. So nice. I just wanted to have
You continue, sir. You continue.
own person on continue. I'm continuing. Can you see the screen now? Public consultations.
Yes, sir. Yes, sir.
You can see the screen now.
Yeah, yeah. It is visible. You go ahead, sir.
Okay. So sorry.
Sir, you go
It
ahead,
is-
sir.
Go ahead, sir. You are go ahead.
Yeah, I'm going ahead. Yeah, please. Thank you. Thank you. Public consultation is very, very important for laying the project or for setting up a refinery or for that matter, any other project. Having seen this, the cost of delay, if there is a delay in obtaining clearances, there will be delay in the project execution and that will result into interest during construction. IDC component, if it is heavier, then naturally it sends a signal that the project is delayed. And if once it is delayed, it results into hundreds and thousands crores of rupees heavy cost. So potential additional financing cost, apart from financing cost, this IDC will be additional burden. So sometimes when huge amount of IDC is there, then the entire project becomes unviable. So time is of great essence in completing the project. So there is a lender also requires complete independent due diligence before lending. For example, you are sitting in credit committee, you are the chairman. I'm addressing to each one of you and to the participants. So if you happen to be on the credit committee and you happen to be the chairman of this, before to decide whether to invest or not, you are a responsible position. So what all things you will do? Will you take the decision on your own, or will you consult some other experts? Experts like technical advisors, environmental consultants, legal advisor, insurance advisor, financial advisor, or some engineering and technologists. So these are the people who will help you, who will guide you, who will help you in taking it forward. Now, what bankability is this term is, bankability doesn't mean that it is profitable. It only means that this project is worth financing. So you can bank upon this project. What exactly bankability means? You can bank upon this project. So it is independent confidence, lenders' confidence that the investment can generate stable, predictable, and sustainable cash flows capable of repaying the debt. Whatever these investors, whether you are a capital provider, you are a debt provider, or you are equity provider, so those people will get their money back, and while managing the inherent risks which are there for undertaking such a project of such a huge scale. So it rests on this bankability depends upon some strong foundations. Strong foundations, technical feasibility, environmental responsibility, legal certainty, commercial viability, financial discipline, and competent execution team. You should have competent people. Now, for example, 75,000 crores rupees, out of that 30% is coming from the equity holders, and 70% is 70% of 75,000 is 52,500. So that has to come from the debt component. So who will provide this 52,500 crores to convert your vision into a reality? So the answer lies not merely in the availability of capital, but in the confidence of those who provide it. So we now leave the promoter's office and enter the boardroom of a consortium of lenders. Only one bank will not do it. So 3, 4, 5, 6 bankers or financial institutions will come together. They will form a consortium, and that consortium will decide that whether it is worth investing or whether financing such a project. So the feasibility report, which we have seen earlier, it is executive summary, it is site selection report, you have seen technology, you have seen utility. I'm going forward slightly ahead. These are that we are already late, but nevertheless, I have to take further infrastructure plan, how exactly, what type of calculations, what type of tankage, what type of pipeline, how the product will move out, what type of schools, township, hospitals, medical centers will be there, what type of buildings, the warehouses, storage, workshops, and then what type of cost estimate for each and everything of equipment cost, big plant and machinery, what exactly is the freight cost, import duty, GST, construction, electrical, instrumentation, commissioning. So each one will have to take it. Now, one question, I don't have all questions, but in the answers in your chat line, can you just see one question is, why do lenders insist that the promoters invest substantial equity before extending loans? I repeat the question, why do lenders insist that the promoters insist substantial equity before extending loans? First, A is to reduce the total project cost. B, option A is to demonstrate promoter commitment and absorb initial risk. C, answer option is to reduce environmental clearance. And D, option is to increase dividend repayments or dividend payments. Can you just see which one is the right answer? A, B, C, D. Your answers are there?
Yes, sir. Someone says it is option B, sir.
B?
People are
How
saying
many people
option
say
B.
option B? How many
It's
people?
2 people right of now.
What about others? Only two people?
2 more people say option B. Total 4 people are saying option B.
Balance all. We want more participation of more and more people. At least 40, 50 people should answer.
So more answers are coming and everyone's are saying option B.
Okay. Shall I go ahead?
Yes, sir.
So the right answer, of course, is B, because the lenders want the comfort that the promoters also show in indication or indicate that they are committed, and they also are about to, or they are also ready to absorb the shocks or the risk of investment. So the component could be debt equity ratio generally is in the ratio of 2:1. So it could be 70%, 30%, 60%, 40%, 80%, 20%. So whichever you choose, then accordingly, the leverage will come into action, and most of us think that 2:1 is the ideal ratio. Okay. And then construction philosophy, the foundation of financing. Mm, So engineering, the execution sequence drives the draw down schedule, the interest burden, and the date revenue begins. So construction philosophy, the foundation of financing. First one is engineering, procurement, construction, mechanical completion. All these things factors are there, finally ending into commercial operation. Every activity carries a start date, finish date, dependency float. You carry out the critical path analysis, PERT analysis, or what should I say, Gantt analysis, Gantt chart. All those things have to be prepared. And capital phasing infusion of complete 75,000 cannot be done at one go in the beginning. It has to be spread over different years, different months also. Sometimes you require 100 crores, sometimes 1,000 crores, sometimes 10,000 crores, depending upon which year, how much is required. That planning has to be done right in the beginning. And revenue model and operating cost model. You have to work it out. What exactly is the capacity utilization, product means, how the revenue will come, entire, and what is the exchange rate, inflation assumption, volume growth. I think these are the things which are built up into the DFR. And the risk register, implementation schedule, in which year, how much each level, you have to calculate these things. If you happen to be chairman of the credit committee, you will evaluate the finance, you will evaluate the strategy, you will evaluate the importance of time, and to what extent it is bankable, how much you are confident of the cash flows which are coming up in the refinery. Now, having seen all these things, we get 5 lessons. Infrastructure projects are engineered twice. First one by engineers, second time by financier. Engineers by engineers are completely of engineering products, and finance people will do the engineering of financial products. How exactly, which component, how much, whether to debt from equity, what are the different sources. So those people will have to do financial engineering. So that will be done by the finance people. A detailed feasibility report does not merely estimate cost, it builds lender confidence through transparent assumptions. So everything depends upon the assumptions. If assumptions come into overconfidence, then it is rejected. People will say it is not a sellable, not a bankable project. So what assumptions, optimistic or realistic assumptions, based on that, the entire edifice draft of feasibility or DFR is carried out. The objective of capital structure is not to raise the maximum debt or maximum equity, but to optimize, to maintain balance, maintain flexibility, and in turn go for long-term value creation. And every financial ratio is a question asked by the lender. There are so many financial ratios, whether it is DSCR, whether LLCR or PLCR, whether IRR or NPV or any other debt equity ratio. So those things, and every assumption in the model is an answer provided by the promoter. And then infrastructure finance is ultimately the discipline of transforming national vision into bankable reality through trust, governance, sound financial engineering. So this is, I have completed first, second, any question from anyone post. So far, whatever we have discussed. Can you hear my slide? Can you see my slide, Dipendu?
Yes, sir. Yes.
Now, it says the objective of project finance. What is the primary objective of project finance for refinery project? Can you see this slide?
Yes,
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 sir.
sir.
Yeah. I think the answers are no participation from the audience. They are there, no?
Yes, yes,
At
they
least
are
they should
there, sir.
acknowledge, they should. Huh?
They are
That
writing
is
in the chat
either
box,
they
sir.
have.
Yeah, yeah.
Sorry?
So they are writing in the chat box whenever they are responding, but they have no questions
Ah,
as of now. We have requested them to ask some questions. So as of now, no questions, sir.
okay. ठीक है, that's good. Now we have got another half an hour. In another half an hour, I'll try to cover actual part as to how the financing takes place. See, money can be borrowed, it can be invested or raised from the public. Capital is more profound. So the essence is steel and concrete are visible. An infrastructure project in that you can see the steel and concrete, it comes through lot of plant and machinery comes up. Capital is invisible, but capital infusion is very, very important. Without that, even plant and machinery or land and building also will not be coming up. Therefore, every rupee invested, it reflects someone's confidence that the project will take place. It will yield some future value. It will bring some economic benefit. Therefore, the investment is made. So it is not only the shareholders, not only the equity providers, even the loan providers or bond holders or governments or local bodies or even international players who want to invest in, all of them depend on one element. And that element is that the confidence. They are investing into the confidence that this project is going to come up, is going to come to fruition, is going to be realized one day or the other, and within the timelines and with the full economic benefits which will be available after it is commissioned. So they are investing, they are financing, they are putting their money in one element, and that element is the confidence or the trust that the project ability to succeed. They are not putting there for failure. They are with such high degree of optimism, with such high degree of faith, that high degree of trust, high degree of confidence in the vision of the promoter and what all studies, case studies have been made. Then it comes to the question of making the capital available for this project. Now, the huge amount wants to raise, but the underlying importance is the objective is to raise the right kind of money from the right investors at the right cost, at the right time, with the right maturity profile and the right allocation of risk. So this is in essence the essence of raising capital. So banks do not finance refineries. Investors do not finance refineries. Government do not finance refineries. Then what exactly they do? They finance the future cash flows of these refineries. The refinery does not repay the loan. It is the future stream of products revenue that does. So therefore, just be careful that these people, these stakeholders, including the governments, they are interested in the future cash flows from these refineries. And therefore, in spite of all, long gestation, in spite of difficulties in marketing, margin uncertainty, global exposure, or regulatory evolution, or political dynamics, all these factors, in spite of considering these complex matters, evaluating that, then only they go ahead. So central objective is to reduce uncertainty. Uncertainty, how it propels from different sources, how exactly uncertainties can be managed, how the risk can be minimized, how the cost of borrowing can be minimized. So there lies the efficiency of an efficient finance manager. So two kinds of engineering, one we have seen already, and the extreme finance. Can we think of financing the whole thing? Let us assume that one company, an existing oil company like IOC, HPC, BPC, having huge surplus of reserves. So can it finance 75,000 crores? Let me tell you, absolutely no problem. They can do it on their own. Will they do it? Or should they do it? Complete financing? Any question from your side? Or any answer from there in the chat lines or in the chat box? Should any company invest complete capital into setting up a refinery? Equity provider, complete 100%, should one company do it?
The participants say it's no.
No, very good. How many people have said no?
As of now, one people.
I think response is not coming either. I don't know what's the reason. There should be participation. Then it makes interesting.
Now, sir,
Otherwise, it
answers
appears
are
that-
coming. Answers are coming. Majority of them are saying no.
Okay. So funding the entire 75,000 crores by only one person or by one banker is not acceptable, not viable, not feasible, or should not be done. Similarly, entire 75,000 crores by only one banker or one financial institution, that is not possible or not admissible or not feasible, or it should not be done. There has to be optimum balance in technology companies, infrastructure projects, refinery projects. All of them have got one thing in common: that the combination of private, public participation and debt equity participation is there. People
So one
think that investing.
participant has written risk mitigation and tax is the reason.
Very right, very right. Good question. Let there be some more thoughts. Many more people should participate. Howsoever, let them comment. Absolutely, we will welcome it. Now, if you put, you are the, what should I say? You are the equity provider. You are putting your own money from your own reserves or from surplus. Do you mean it doesn't have any equity cost? It doesn't have any implicit cost? It does. Your own money has got opportunity cost. It has got implicit cost. So that has to be worked out. Debt, definitely there is an outflow of interest payment. So it has got explicit cost. But if you are holding money from your own pocket, it may not be having explicit cost. You are not paying interest to yourself, but it has got implicit cost. And that is opportunity cost of investing somewhere else, earning much, much higher amount. WACC, how many of you know WACC? So WACC is weighted average cost of capital when there are structures of debt and debt and capital, and the two of different forms of debt, different forms of capital, different weights are there, somewhere 10%, somewhere 40%, somewhere 30%, somewhere 80%. So all those debt and what exactly is the cost of each type of source of capital multiplied by its percentage, then sum total will get average weighted cost, weighted average cost, WACC. So that WACC has to be calculated for the complete component of debt and equity. And then you come to know, and that WACC will be the most important factor for determining your IRR, for determining your hurdle rate. So that WACC becomes your hurdle rate. Minimum you should attain. If you get more than that, how much more benefit you are getting, more the merrier. Now we will see capital structure. Capital structure should be component of equity, domestic debt, international debt, bond market, government support, export credit agencies. We will see these are the providers of capital. We will see how best from different sources you get it. So the thing is, so the 6 questions for every source of finance, whether it is debt or whether it is share capital. So decision, why choose it? What does it cost? What risk come with it? What conditions apply? How does it compare? And what advantages are there? How to approve or what to reject? How much to reject? So all these components have to be taken. When a consortium of bankers come together to finance, then they decide whether to take equity and how much, if so, and whether to go for debt component. And then they will split a domestic and international debt. They decide whether to include bonds and what type of bonds, evaluate export credit agencies support and overseas capital markets, and balance cost, risk, flexibility, and currency exposure. So all these things have to be evaluated. Equity investors receive no guarantee. You know very well, equity providers, they take that risk till completion of the entire project. During this 5 years, 6 years, 10 years, probably they will not get any returns. Return will come only when the refinery or the company generates some surplus, some cash surplus. Then only they will get the benefit. And if the refinery gets or excels, and the shareholders enjoy very good appreciation, their share value from 100, it will go to 500, 5,000, 100. So 10,000, it appreciates. And if it struggles, shareholders bear the complete loss. They are that you know very well the come on this one. And internal accruals, surpluses, those things are reserves. They also provide the capital. IPOs and FPOs. Say you can take the float the company, your existing company, and you want to become, what should I say, a holding company. You can finance the company from your own source, from own resources. Also, you can source from IPOs. One separate company can be made, and then fresh capital also can be raised by IPO, and also FPOs. Also, if existing company wants to raise the funds and then provide that capital to the subsidiary, all those things can be done through IPOs and FPOs. Some other companies or existing oil companies like IOC, HPC, or joint venture companies, they can form part together and they can make a joint venture. And in the joint venture, it can be made. And India and Saudi Aramco can also form together, or ADNOC, Abu Dhabi National Oil Company, can be taken, or PDO, that is Petroleum Development Oman, an Indian company, can form joint venture. So there are different ways by which consortium not only of banks can take place, but also consortium of companies can take place for making a joint venture and provide the capital. Apart from this IPO, in IPOs also there will be qualified institutional placement. People will be there. There will be right issues. There will be strategic investors. And there will be bond holders. We will see a little later. Why not finance everything from equity? That we have already said, it is not advisable. Everything cannot be through one consortium, one banker. So there will be consortium of bankers, and then they will pull together. We have seen, and one person will be acting as a lead manager or lead arranger, and he will he will undertake complete due diligence, negotiate common terms and conditions, and enter the agreement and monitor the progress from time to time. That lead bank will take the whole responsibility for dealing on single-handedly with the Treasury Department of this refinery. Why the consortium structure, how it works? Of course, you have seen, you know very well that risk distribution and then collection, all those things can be done nicely. So, security repayment, you have to be considered what exactly is the repayment or moratorium or interest during construction and amortization, as the consortium bank will have to take into account all these factors. So one has to consider that question comes, is the cheapest loan the best loan? Is the, and this question is for the audience also, is the cheapest loan the best loan? Participants often assume that lower interest rate automatically means a better proposal, but it need not necessarily. A slightly costlier loan with longer tenor may be more valuable, because you cannot go again and again for floating, refloating your loan documents. It is a long term for 5 years, 10 years, then it will be much better. And it is available at the time when the rates are low. Then it is better to go for long. Flexibility during construction can outweigh lower nominal value. In another, in most of the cases, cheapest loan is not always the best. You have to consider in its entirety. Now, if you just see what should be the different components, equity will consist of, as I said, internal resource and fresh equity from IPO, FPO, or strategic investors from foreign, like Saudi Aramco or NOC or MPDO or ExxonMobil or something like that, if those people are invested. So out of 75,000 crores, you can take something from internal resource, about 7,500, about 10%, then 20% from fresh equity. So the total component of equity could be 30%, balance 70% will be debt. So in the debt also, consortium loan from the banks may be 40%, that is 30,000 crores, and then bonds, NCDs or convertible bonds or non-convertible debentures, and then international financing. So that could be 10%, 20%, depending upon your requirement. So the entire 100%, 70% will be debt and 30% will be equity. Can one just one want to ask one question? Involvement of more and more people. Slightly, I'm disappointed with the response. Very few people are answering, although 200 people. So now, just want your question: which government initiative directly improves the project bankability? Project becomes bankable when it becomes feasible. So tell me, which government initiative? If first one, as the answer is increasing the number of shareholders. Number one. Number two, faster statutory approvals, infrastructure support, and appropriate fiscal incentives. C option is increasing promoter salaries. D option, changing refinery technology every year. Out of these four options, which you consider is the relevant for the government initiative to participate in the financing or bankability of project? Any question? Any, sorry, option out of this four, which one is the right answer you feel? A, B, C, D.
The participants are saying option B.
Very good. How many?
Around 10 to 12 people.
Excellent. I'm happy at least we have crossed 10, 12 answers. That's very good. Good question. Faster statutory approvals, if you get, the more we will come to the role of government in infrastructure or the development still later. Now the thing is, see, there is a difference in the approach of a banker. Banker is interested in recovering his principal, in recovering back his interest. Whereas when government sees, government is not so much interested in a repayment of capital. capital or repayment of interest, but it is more interested in how much society will gain, how much the state will gain, energy security, to what extent it will be provided to the country, how much import substitution will take place, how much export potential is there, how much employment will be generated, and how much industrial growth, subsequent linkages will improve, how much forward linkages will improve, how much regional development and the entire long-term public value will increase. From that point of view, God will think of giving a push to this project. So banker side is completely different. His way of looking each provider of a capital, whether share capital or debt capital. So the approach of each person is different. So refinery is an industrial nucleus, and you have seen already these things. The government can provide sometimes viability gap funding. What exactly VGP or viability gap funding? When you find that the commercial expediency or the commercial interests are not very high, but economic benefits are very, very prominent, in that case, the difference between commercial viability and economic benefit, that difference, what that gap is there, that gap government wants to put in from its own budgetary source. It can do it in certain cases, will do it in certain mega projects, urban projects, or some infrastructure project. Government has done it, VGP, through union budget funding. So it reduces the initial capital burden, it brings the capital available to the project, and it results in, it facilitates the development of the project. Although it is not that it is leading to or contributing to inefficiency, but it is trying to remove the barriers which are coming in the way of an economically beneficial project. There is a difference between commercial viable project and economically beneficial project. Are you getting me? I hope you understand. So government view is economically beneficial project, and a commercial provider will see commercial viability of the project. So therefore, this viability or
So one response has come, sir. Sir,
yeah.
viability gap funding, green ammonia, and coal gasification. One message has come in the chat box.
Yeah, very good. See, in green green, what should I say, green revolution or green funding is required. So government will give lot of importance to hydrocarbon, or what should I say, biodiesel or ammonia or hydrogen related or green energy products. Therefore, these projects by themselves will absolutely, commercial takers will say these are commercially non-viable. But where government finds that from environment point of view, it results into certain benefits, some social benefits, some environmental benefit, then the government does VGF, that is viability gap funding. Thank you for contributing. Good thought. Although I have give answer in short, but it is possible the government will step in into such projects which it finds green revolution or greenery or green economy is going to come into action, because everybody is very conscious of ESG, environmental, social, or whatever governance, all those things. Government is very keen in giving funding for this type of projects. So therefore, we have seen that VGF can be done, and government also can play a role of providing land, industrial regions, external influence. Government itself, for example, is not interested out of 75,000, for example, they are not interested even in putting 10,000 crores, but they can put a facilitative role by providing a huge land. They can, what should I say, help these promoters to acquire, say, 5,000 acres of land, 6,000 acres of land. There are difficulties in acquiring the land. and this is into so many patches, so many villagers are there. Can the government come into rescue? And then from viability point of view, that the project is going to be economically beneficial, they will help in acquiring such a huge acres of land. Then they will develop, what should I say, roads supporting connectivity, railroad and foods. This is totally outside the complex of refinery gate, but they can help. And then putting up big, deep draft ports or deep draft jetties, and then power plants, availability of water, availability of power 24/7. These are roles which government can play, and also the government can play a great role in reducing the taxes or giving some concessions. Concessions agreements will be made, and then GST reduction or GST waiver of, or earlier we used to have investment allowances also there. So taxation or fiscal prudence also is there, by which start refined areas, exemption from income tax for next 5-10 years. So these are the things by which government supports such mega projects. The government equity and single window facilitation at one stroke you go, otherwise you go to 30 different departments to obtain the clearances. It becomes terribly delayed action, and person really he goes into much difficulty, and it elongates what should I say, it differs 2 years, 3 years, 4 years. Commencement of the project itself gets delayed, and during this time, the ITC interest during construction also becomes. So, if the government gives one window clearance, which nowadays, as part of ease of doing business, certain governments or even central government is giving thrust to this idea, that is very good. So this is what government intervention brings lot of good impact. If government blessing is there on any project, take it for granted in different ways. You get the blessings, you get the ease in putting up the facilities. Having seen the government, having seen the banker, having seen the capital provider from internal, now we will take a leap. We will go beyond the border of India, taking FDI investment, how best we can move out. This capital doesn't have doesn't have any constraints, no nationality. It can fly everywhere from Japan to America, America to China, China to Brazil, or Brazil to Greece. Everywhere the capital flows in the throughout the world is taking place at amazing speed. So we also can look into tapping that. How exactly? Through bonds, through different ways of raising finance from outside. Even share capital also can come. We can request the foreign oil companies to become part and parcel of the shareholders of this company. For the simple reason, these refineries require huge amount of investment and excellent high degree of complexities, and these complexity providers are mostly foreign countries. So those foreign countries can not only provide capital but also provide the technical support. They can support the technology, they can provide the technology there, and competent technical experts also. So just there is a big advantage in availing the facilities from abroad also. You have to think of taking it. Have you heard of ECA, Export Credit Agency? Anyone? What is the principal objective of Export Credit Agency financing? Have you heard of it? Can you say yes or no? ECA financing. Anyone? Just write yes or no. ECA financing. Anyone knows what it is? I want your involvement. Any answers, Devinder? You can say no if you don't know.
Some participant says no.
people don't react also, yes or no? No problem. I don't know whether they are listening, they are present.
Some participants are saying option B to these poll questions.
Participation. That's very good. Excellent. This is a question which is hanging out. So very nice. I'm happy that some people are participating. Hey, what is the principal objective of export credit agency? Export program, these are the agencies which promote exports from their own country, from their home country. They give a push to the exports of plant, machinery, technology, so and they will finance at much lower rate or something, so that the exports from their country are promoted and it is sent to the importing country. So this is the essence. Of course, they charge the provider of exporters something, their commission. So those export credit agencies, they are working in UK, Europe, in America, in Canada, everywhere. So those people give a push to their national policy of export promotion, and then they lend a lot of money to those manufacturers of plant and machinery, which are finally exported to our country. So of course, their conditions are attached, everything, and then they get in turn some commission. So apart from ECA, we will look into ECB. What is ECB? Anyone, any idea ECBs? Yes, no? External commercial borrowings. Any idea? Hope you have heard of it. Any answers?
Participation says yes.
Okay, very good. Excellent. Thank you very much. So, it is external commercial borrowings takes place from huge investment banks, international banks, financial institutions, and then pension funds. Huge pension funds are there, and they provide liquidity, they provide long-term capital, and then they provide should I say technology also. These are the people who help to enhancing commercial ECBs. So of course, they have got their own strict rules, regulations, terms, and conditions for financing this project. Hedging the total cost of foreign debt. If you have raised 20,000 crores of rupees, you have to pay interest, and the interest rate also, what should I say, the exchange rate changes, and interest rate also can change if you go for floating rate of interest, and the exchange rate for repayment of capital also will be changed. Today, the dollar is trading around say 95, 96. It can become 100, it can cross to 110, it can become 110, 20. If that is so, it becomes very, very costly. For example, the foreign loan is available at 4% interest, whereas in India, it is 10%, 12%. Naturally, foreign funding is cheaper, but the thing is that 4% becomes much more costly because exchange value or exchange factor is against India. If that is so, then you will be paying much higher. So there is a mechanism called hedging mechanism by which you protect your interest in repayment of principal amount or interest derivatives are there, and so those things you can, currency derivatives are there. Both the derivatives you can take to hedge the risk of falling rate or interest going against you. So these are the things which are there. Consortium of banks or consortiums or ECPs or ECA, let me tell you, international bond market is also there. For example, Infosys has raised, or Satyam also had raised, even in New York bonds. There are from Switzerland bonds are there, in yen-denominated bonds are there. In all these are foreign currency bonds which you can float and then you can take them. So the risk is there, of course. Here also it is available at much cheaper rate. Interest rate, but the thing is you need to hedge the currency risk as well as the risk of interest bond market. And then any area of bonds? Yes or no? Masala bonds are rupee dominated bonds which are floated in international market. So although they are rupee dominated, they are not available in India. They are available in international, in Dubai or Singapore or in Mauritius or in New York and London. So from there, the funds float to India. They are, of course, you have to repay only rupee. There is no risk, absolutely no risk. Same rupee amount will go and get credited to those people who are providing the capital. So this is how these things are. Then the World Bank, IFC, International Finance Corporation, Asian Development Bank, and then different banks are there, even IMF or some bodies of IMF. These people provide multilateral development institutions loans for setting up infrastructure projects. So this is how, and all these things require that, for example, a refinery of 75,000 crores in Andhra can be having some participation, domestic equity, something from banking consortium from India, something from ECA, something from ECB, something from foreign bonds, foreign currency bonds, something rupee denominated bonds, something from multilateral development plan. So combination of all these will be financing the refinery requirement. So this is how. We will just take a few minutes more to discuss. I think I'm already exceeding 12 minutes, but nevertheless trying to complete another 5-10 minutes. Ratios. So what exactly financial ratios are unique to the refinery organization? So the thing is, what exactly are this one? The first thing is, if you are credit provider, invested 70% by way of 100, then what ratio you will see? Naturally, it is ratio of 70-30. 70 is debt and 30 is equity. So this is how debt equity ratio is 2 is to 2.3 is to 1, 52,500 and 22,500. This is the ratio. Interest coverage ratio, how by interest coverage ratio. That what is debt service coverage ratio? Coverage ratio, it actually the project to service debt from the operating cash flows. What are the operating cash flows of that during the next 5, 10, 15, 20, during this entire period of project? What exactly is the net what do you call it, operating profit divided by how much is the amount of what should I say? That is debt. How much debt is their component of debt? You get this one, DSR. DSR, as far as possible, should be more than 1. It could be 1.2, 1.3 is quite good. Then there is a comfort that the net operating profit is sufficient enough to pay the entire amount of debt component. Then we will see LLCR, then we also will see PLCR. What is loan life coverage ratio? See the sum total of that net capital, what should I say, net operating flows divided by the loan outstanding loan during this period. If it is for 10 years period, so what exactly the sum total of that debt will be taken into account, then it will give the indication whether it is 1.2, 1.3, 1.4. Ideal should be 1.3 to 1.4 loan life coverage ratio. Then project life coverage ratio. Here we are not talking about just the loan, the duration of loan. We are calculating the complete project life. project life, maybe say 30, 40 years. During that period, how much is that? So that defines what exactly is project life coverage ratio. So all these, and then of course IRR is there, NPV is there, and then sensitivity analysis and different parameters. When you go to your board of directors, or you have to calculate IRR, NPP, and then DSCR and all LLR, show them as to what are the comfort and how the scenes are changing. If you just have the changes in the main assumptions could be to the crude oil, it could be the cracks, the margin, product margins, or different aspects of expenditure, or certain time shutdown, or some abnormal thing. Everything, if the board of directors want to understand different complex scenarios, so the most optimistic, the most pessimistic, and the most moderate, everything, the entire data, the entire worksheet should be available with you, so that a confidence is shown to the builders, shown to the financiers, and to the main equity provider as to how this project is viable. So this is how we work, and then we come to a decision that this is a bankable project. Now I'm trying to complete this another 2-3 minutes. Not a single barrel of crude has been processed, not 1 liter of petrol has been produced, no aircraft has received any aviation fuel, no truck has carried. But thousands of crores of capital committed. Why? Because you have got confidence that this will result into cash flows in the future. So that is the essence of infrastructure finance. So now the final takeaway, could anyone say A, B, C, D? Just I'll read out which statement best describes infrastructure financing, having heard of for almost 2 hours. Which statement describes the investment financing? It is primarily about obtaining the cheapest loan. B, it is mainly about preparing financial statements or projections. C, it is the process of converting a technically feasible project into a bankable investment through sound risk allocation and capital structuring. D, it is only about obtaining government subsidies. Out of these 4 options, which one is the best?
People are saying option C.
How many?
Sir, around 12 or more.
About wonderful. Some more coming?
Yes. More are coming. More. Everyone is saying option C.
I'm glad people have understood the entire essence of this 2 hours webinar. And so this is the essence. The essence is the process finance, infrastructure finance is the process of converting a technically feasible project into a bankable investment. That is the essence. Finance follows confidence. We have been talking about the confidence. We are not talking about capital. Capital resulting into confidence, making it bankable. That is the essence. So infrastructure finance is not about arranging money. It is about creating confidence. Confidence among investors, confidence amongst lenders, confidence among the government, confidence among regulators, confidence among contractors. In other words, all the stakeholders gain confidence, even the society, even the villagers, even the people who are in the surrounding vicinities. Nobody is objecting. They're all happy that something they are going to get benefit. And that confidence among the society, that skills, financial resources are being committed or being entrusted to this project, which is capable of creating an economic value and social value, which is of enduring benefit, which is of long-term benefit, sustainable benefit. That is the essence. And so, having heard all these things, I just want to say a wonderful thank you for being part of this wonderful journey of 2 hours. I think I tried to do my best in speaking spite of still darkness in my room, and thanks to the mobile data mobile, I have been able to connect and then convey certain things. So a refinery is not merely an industrial complex; it is a collaboration between technology, finance, law, public policy, economics, dynamics, or should I say, no, governance, and finally, human confidence. Thank you very much indeed to all of you for joining and making it happen. Thank you very much. Over to you, Dipen. Any question? I'm happy.
Thank you, sir.
Dipen?
I think if there are questions, sir, we can give you. Everybody is appreciating the session, sir. Excellent session, and they are thankful for your wonderful presentation. I know some hitches happened, and we cannot help. It's nature which is not having any programming with us. We can only hope for the best. And I thank you wholeheartedly for your kind presentation, sir. In spite of such hassles, you have made it possible. You have spared more than 2 hours to give us the thought process, and we are doing this webinar in association with Baroda chapter, and I am very happy to say Amrita Vyas madam who is the chairperson of Baroda chapter. She has joined as a and I thank madam. She is not only Baroda chapter chairperson, she has been featuring in the top 16 successful women in Vadodara city, and she is also managing partner of Diwanji and company. And madam, your closing comments and vote of thanks from your end, madam.
Yes, definitely, Debenduji. Thank you. As we come to know to the end of the today's CP program, so I would like to express my sincere gratitude to our esteemed speaker, CMA Kazi Mohammed sir, for delivering such an insightful and the informative session on the infrastructure financing in downstream oil sector. Sir, your in-depth knowledge and practical insights, comprehensive explanation of the financing ecosystem, investment challenges. We have seen the risk assessment policy framework and future opportunities in the downstream oil sector have provided us with a valuable perspective. So your expertise has not only enhanced our understanding of this specialized area, but has also inspired us to explore the subject with a greater interest and confidence. So I also extend my heartfelt thanks to the Banking, Financial Service and Insurance Board IC of the ICMI for their support in organizing this program, and also special thanks to the all the participants, and your commitments to the continuous professional learning makes this program meaningful and successful. So on behalf of Baroda chapter, I say thank you all. Have a wonderful evening and stay safe. Thank you, sir. Thank you, Kazi, sir.
So nice, so nice. Thank you
Yes,
very
sir.
much, madam. So
Yes.
nice. Just a last word I just want to tell you.
Yes, sir.
I'm an arbitrator of domestic and international commercial disputes. So there are a lot of disputes in infrastructure sector, and in infrastructure sector, the presence of cost accountants is very, very important in allocation of cost, in putting up the claims, in putting up counter claims. So it has to be done in a very nice way. There are special formulas over which only the cost accountants have got the mastery or should have the mastery. Those formulas are called Hudson formula. Second is it is about head office allocation cost, and these are in international disputes. These things become very difficult to calculate cost allocation. So head office allocation cost has to be done by professional cost accountant. I just want that the our institute should liaise with the Society for Construction Law, take it forward so that our cost accountants are engaged in these services for putting up and framing up proper claims and counterclaims. This is my just as an idea to the institute. I hope Amrita, you will be able to take it forward.
Yes, sir. Yes, sir. Thank you, sir. Yeah, so Dibendu ji, we
So
can
thank you very
conclude
much,
the session
Dipendu. Thank you
today's
very
session.
much.
Thank you, sir.
Yes.
Now from our institute, I will request Roop Biswas to give the formal vote of thanks. Roop, over to you.
Thank you, sir. On behalf of the Banking and Financial Services and Insurance Board of the Institute of Cost Accountants of India, I extend my sincere gratitude to our esteemed Chief Speaker, CMA Qazi Muhammad Riazuddin sir, practicing cost accountants, for his enlightening and thought-provoking deliberations. I would also like to express our heartfelt appreciation to our chairman, CMA Chittaranjan Chattopadhyay sir, BFSI board, for his constant guidance and leadership in bringing such relevant knowledge initiative to the professional community. I would also like to express my sincere gratitude to the CMA Amruta Vyas Madam, chairperson of ICMI Baroda chapter. I would also like to express my sincere gratitude to our head of the BFSI department, CMA Dipendu Roy, for his continuous guidance and support. Our sincere thanks to all dignitaries, members, participants who joined us today. Your active presence and engagement have made this session meaningful and impactful. With this, we come to the close of the today's session. Thank you for all for this valuable time and participation. Wishing you a
Thank
pleasant
you.
evening ahead.
Thank you.
Thank you and Jai Hind.
So
Thank you, sir.
thank you.
We are
Thank you.
closing for today.